Numbers on a screen can quietly change a life, and today, one of those numbers forced me to make a decision I did not expect to make this soon. I'm selling half of my Nvidia stock, not because I think the company is dead, but because smart investing is not about holding forever. Here's what I'm buying instead. This is not a panic move. This is not fear. This is a strategy shift that most investors only understand after they lose money, not while they are still sitting on big profits. Nvidia is one of the strongest companies in the world right now. It powers the AI boom. It sits at the center of data centers, cloud computing, and advanced chips that almost every major tech company depends on. Its rise has been historic. Its growth has been explosive. Its story has been almost too perfect. And that is exactly where the real risk begins to hide in plain sight. In this video, you will learn why holding on to a winning stock for too long can quietly become more dangerous than selling too early. You will see how valuation, competition, and market psychology play a bigger role than company performance. You will understand why trimming a position at the right time is not weakness but discipline. You will also discover the alternative investments I am moving into and why these choices may offer a better balance of growth and safety in the coming years. Many investors believe that if a company is great, the stock must always be a great buy. That idea sounds logical, but history shows it is often wrong. Great companies can become bad investments when the price runs too far ahead of reality. This is not about predicting a crash. This is about recognizing when expectations become too high for any company to satisfy, even one as powerful as Nvidia. There are signs in the market that most retail investors ignore. Large funds quietly reduce exposure while headlines stay positive. Competitors start gaining ground while the spotlight remains fixed on one leader. Supply chains tighten, margins face pressure, governments begin to watch more closely. These small signals do not show up in social media posts or short news clips, but they matter more than hype. Another truth many people do not realize is that Nvidia's biggest customers are also trying to reduce their dependence on Nvidia. Tech giants are building their own chips. Startups are entering the AI hardware space. Alternative architectures are being tested. None of this means Nvidia will fall. It means Nvidia may no longer be the only obvious winner, and that changes the risk-reward equation for investors. You will also learn why concentration risk is one of the silent portfolio killers. When one stock becomes too large in your portfolio, your future depends on a single story going perfectly. No delays, no competition, no policy issues, no slowdowns. That is a dangerous place to be, even if the company is exceptional. Selling half allows me to lock in gains, reduce risk, and still keep exposure to Nvidia's future. It is a move based on balance, not emotion. The next part of this video is where things become even more interesting. I will show you the companies and sectors where I see the next wave of opportunity forming, areas connected to AI and semiconductor growth, but not priced with the same level of extreme expectations. These are businesses that benefit from the same trend without carrying the same level of attention and pressure. Some of them sit behind the scenes of the AI revolution. Some of them supply the essential parts that make Nvidia's success possible. Others compete directly but are valued far more reasonably. This shift is not about chasing the next hot stock. It is about positioning capital where the upside is strong and the downside is more controlled. You will also see how professional investors think during moments like this. They do not ask whether a company is good. They ask whether the current price still makes sense compared to future growth. That difference in thinking separates long-term winners from emotional holders. There is also a psychological trap that comes with big winners. The fear of selling too early often keeps people from selling at all. Profits on paper start to feel permanent, even though markets can take them back faster than they were made. This video will help you see why partial selling can be a powerful tool that very few retail investors use correctly. By the end of this video, you will understand the exact reasoning behind my decision, the hidden risks that are building around Nvidia's stock price, the logic behind my new investments, and how you can apply this thinking to your own portfolio without needing to predict the future. This is not financial advice. This is a real portfolio decision explained with full transparency, so you can learn from the process. If you own Nvidia, if you are thinking about buying Nvidia, or if you are simply trying to understand how smart investors manage winning positions, this video will give you a new perspective that most channels never discuss. Stay with me until the end because the final part connects all the pieces together and shows how this move is part of a bigger long-term plan, not a short-term reaction. Welcome to our channel, where we break down complex investing ideas into simple practical thinking you can use. And if you value clear, honest insights like this, make sure to subscribe so you do not miss what comes next. A stock can be excellent while the price becomes dangerous, and that is the uncomfortable place Nvidia has slowly moved into after its massive run. The company is still powerful, the business is still strong, demand for its chips is still high, but the market price now carries expectations that are almost perfect. The stock has climbed so far so fast that many analysts are no longer asking how great Nvidia is. They are asking whether any company on earth can grow fast enough to justify this level of pricing. That shift in question is important. It shows that the story is no longer only about growth, it is about whether the growth is already fully priced in. When a stock runs this hard, past gains start to get mistaken for future certainty. Investors look at what already happened and assume the same speed will continue. But markets do not move in straight lines forever. At some point, the growth rate slows, not because the company fails, but because the expectations became unrealistic. This is where risk begins to hide behind good news. Nvidia's valuation now assumes that AI spending will keep exploding without delay, that customers will keep buying at the same pace, that no serious competitor will take market share, and that margins will remain very high even as others enter the field. That is a lot of perfect conditions that need to stay true at the same time. Even small cracks in that picture can change how investors see the stock. Large funds and professional investors have started to speak more carefully about Nvidia. The tone is changing from excitement to caution. Some hedge funds have reduced positions quietly. Some analysts have used words like overextended and overheated. A few have even used the word bubble, not because Nvidia is a bad company, but because the stock price has moved ahead of the story. This is something many retail investors miss. They hear that Nvidia is essential to AI, and that part is true, but they forget that even essential companies can become overpriced investments. A great business does not always mean a great buy at every price. When expectations get too high, the stock becomes more sensitive to any disappointment. One slower quarter, one delay in orders, one sign of customer resistance. That is all it takes to trigger a sharp correction, not because Nvidia is failing, but because the market demanded perfection. At the same time, the competitive landscape is changing faster than most people realize. Nvidia built an incredible lead in GPUs for AI training, but the rest of the industry has been watching carefully. Big tech companies that buy Nvidia chips in massive quantities are now trying to design their own alternatives. They do not want to depend fully on a single supplier. This is normal in business. When one company becomes too dominant, customers start looking for ways to reduce reliance. Cloud providers are investing billions into custom silicon. Chip startups are entering the market with new designs built specifically for AI workloads. Even older semiconductor companies are adjusting their focus toward AI acceleration. None of these players need to beat Nvidia completely to make an impact. They only need to take a small portion of the market to change the future growth path. That is what makes this situation delicate. Nvidia does not need to lose its leadership to face pressure. It only needs to face more options in the market. This is where risk management becomes more important than excitement. When one stock grows too large in a portfolio, the future becomes tied to one story. Even if that story is strong, the concentration creates vulnerability. A portfolio should not depend on a single company delivering perfect results year after year. Selling half is not a loss of faith, it is a way to protect gains and reduce the emotional weight of holding a very large position. Locking in profit changes the psychology. It allows me to stay invested without feeling exposed to every small headline. It also reduces volatility. If Nvidia drops sharply, the portfolio feels the impact less. If Nvidia continues to rise, I still benefit. This balance is powerful. Many investors hold on to full positions because they fear missing out on more gains, but they forget that protecting what they have already earned is just as important. With that thinking in place, the next step is not to move away from AI or semiconductors. The goal is to stay in the same growth theme, but shift into areas where the expectations are more reasonable. This is where AMD comes in. AMD is Nvidia's closest competitor in GPUs and AI chips, but it trades at a much lower valuation. The company has been building serious technology that can handle both AI training and AI inference, which are two different but equally important parts of the AI process. Training is where models learn from data. Inference is where those trained models are used in real-world applications. Nvidia dominates training today, but inference is expected to become a massive market as AI moves into everyday products and services. AMD has positioned itself to compete strongly in this space. That creates an interesting opportunity. The company benefits from the same AI wave, but without carrying the same level of extreme expectations in its stock price. AMD also has another advantage. It is already deeply involved in CPUs, data centers, and gaming hardware. This gives it diversification inside the semiconductor space. It is not fully dependent on one product line. Its growth can come from multiple directions. This makes the risk profile different from Nvidia, where the story is heavily centered on AI GPUs. AMD has room to surprise investors with upside because the market is not demanding perfection from it yet. That difference in expectation can be very valuable. If AMD executes well, the stock has space to re-rate higher. If it faces challenges, the downside may be more limited because the price is not stretched to the same level. This is the kind of shift that fits well with the idea of trimming Nvidia, staying in the AI theme, but moving into a competitor that still has room to grow. The second company I am buying instead is Micron Technology. At first, Micron does not get the same attention as Nvidia or AMD because it does not make GPUs. It makes memory chips, but memory is one of the most critical parts of AI infrastructure. Every AI server, every data center, every advanced computing system depends heavily on high-performance memory. As AI models get larger and more complex, the need for fast and efficient memory increases. This is where Micron plays a key role behind the scenes. It supplies the memory that allows these powerful chips to function properly. Without advanced memory, even the best GPUs cannot perform at their full potential. Micron's business is also improving quickly. Demand for memory and AI systems is rising. Pricing cycles in the memory market are turning more favorable. Revenue growth has started to accelerate after a difficult period in the semiconductor cycle. What makes Micron attractive is that it gives exposure to the AI boom without being directly tied to the GPU race. It benefits from the same trend but from a different angle. This adds diversification within the semiconductor theme. Instead of betting everything on which company wins the GPU battle, this position benefits from the overall growth of AI hardware demand. As more data centers are built and more AI servers are deployed, Micron's products become essential. Another important factor is valuation. Micron's stock price does not reflect extreme expectations. It has gone through cycles before, and investors are more cautious with memory companies. This creates an opportunity when the cycle turns positive. If AI demand continues to grow, Micron can experience strong earnings growth without the pressure of unrealistic forecasts. This kind of setup fits perfectly with the strategy of reducing risk while staying exposed to the same long-term trend. The move from Nvidia into AMD and Micron is not random. It is a shift from one very concentrated, highly priced leader into multiple companies that benefit from the same story at more reasonable prices and with different risk profiles. This approach spreads exposure across competition, supply chain, and infrastructure. AMD competes directly in AI chips. Micron supports the entire system with memory. Both are connected to Nvidia's success, but neither carries the same weight of expectation. This is the core idea behind selling half of Nvidia. It is not about leaving the AI revolution. It is about participating in it in a smarter, more balanced way that reduces the chance of a single stock dictating the future of the portfolio while still allowing strong upside from the continued growth of AI technology. Behind every powerful chip that makes headlines, there is a company that actually builds it, and that company is Taiwan Semiconductor Manufacturing. TSMC does not design flashy products. It does not dominate news cycles. It does not become the center of social media excitement. Yet, without TSMC, many of the world's most advanced chips would simply not exist. Nvidia depends on TSMC to manufacture its most advanced processors. AMD depends on TSMC. Apple depends on TSMC. Qualcomm, Broadcom, and many other technology leaders rely on TSMC's factories to turn designs into real silicon. This makes TSMC one of the most important companies in the entire technology ecosystem, even though it stays mostly in the background. That quiet position is part of what makes it attractive. It benefits from the growth of many companies at the same time, instead of depending on the success of just one. TSMC's manufacturing leadership is not easy to copy. Building advanced semiconductor fabrication plants takes years, billions of dollars, and deep technical knowledge. The equipment is complex, the processes are difficult, the margin for error is extremely small. Only a handful of companies in the world can even attempt to compete at the highest level of chip manufacturing, and TSMC is far ahead in the most advanced nodes. This is why major tech companies trust it with their most important products. They know that TSMC can produce chips at a scale and quality that very few others can match. This creates a strong competitive moat that protects its business over the long term. One of the most interesting facts about TSMC right now is that its factory capacity is largely booked out through 2025. This means customers have already reserved production for years in advance. That level of demand provides visibility into future revenue that many companies do not have. It shows that the need for advanced chips is not slowing down. AI growth, smartphone processors, data center expansion, and many other trends all flow through TSMC's factories. Instead of betting on which chip designer will win the most market share, investing in TSMC allows exposure to the entire industry's growth at once. As long as the demand for advanced semiconductors increases, TSMC benefits. This is very different from holding only Nvidia. Nvidia's future depends heavily on its own execution and market position. TSMC's future depends on the success of dozens of companies across different sectors. This diversification inside the tech space is powerful. If one company slows down, others continue ordering chips. If AI demand grows faster, TSMC produces more AI chips. If smartphones recover, TSMC produces more mobile processors. The company sits at the center of multiple trends at the same time. That reduces the risk of relying on a single story. TSMC also has a valuation that reflects steady growth rather than extreme excitement. The market respects its importance, but does not price it with the same intensity as Nvidia. This creates a better balance between risk and reward. There is less pressure for perfection. There is more room for stable performance. This is exactly the kind of shift that fits the strategy of selling half of a highly priced stock and moving into something connected but more balanced. TSMC gives exposure to the same semiconductor boom without the same level of market hype. At the same time, not everyone feels comfortable holding only semiconductor and AI-related stocks, even if they are diversified within the theme. This is where optional defensive picks become useful. Adding stability to a portfolio does not mean giving up on growth. It means reducing the chance that market volatility can damage long-term progress. Broad market ETFs, dividend-paying companies, or funds focused on stable sectors can provide this balance. These types of investments move more slowly. They do not swing wildly with every headline. They offer consistency when high-growth stocks become unpredictable. Dividend companies, for example, return cash regularly. This creates a steady flow of income that does not depend on stock price movements. ETFs spread exposure across many companies, reducing the impact of any single stock's performance. These choices may not feel as exciting as owning a fast-growing tech leader, but they serve an important role. They create a foundation that allows the rest of the portfolio to take calculated risks. When part of the portfolio is stable, it becomes easier to hold growth stocks through volatility without emotional stress. This idea is especially important after a stock like Nvidia has grown so large in a portfolio. The temptation is to let the winner keep growing unchecked, but balance requires adding assets that behave differently. Defensive picks do not replace growth investments. They support them. They reduce overall swings. They provide psychological comfort during market downturns. They allow long-term plans to continue without panic. Even with all these changes, it is important to understand that Nvidia may still produce strong long-term gains. Selling half does not mean expecting the company to fail. Nvidia remains a leader in AI hardware. Its technology is advanced. Its customer relationships are strong. The demand for its chips is real. Keeping half of the position allows continued participation in that future. If Nvidia keeps growing, the portfolio still benefits. This is not an exit, it is a rebalance. The key idea here is diversification without walking away entirely. Many investors think in extremes. They either hold everything or sell everything. A partial sale creates a middle path that is often smarter. It reduces risk while keeping opportunity alive. It allows gains to be protected while still staying connected to the original investment story. This approach removes pressure from needing to be perfectly right. If Nvidia rises, there is still exposure. If Nvidia falls, the impact is reduced because capital has been moved into other strong areas. This price and risk perspective is what changes the way a portfolio behaves over time. Instead of relying on one stock to carry everything forward, multiple companies and sectors work together. TSMC provides exposure to the entire semiconductor industry. Defensive picks provide stability. Remaining Nvidia shares provide continued access to the AI leader. This combination creates a structure that can handle both growth and uncertainty without depending on a single outcome. I still believe in Nvidia's future, and that is exactly why I did not sell everything. The company is strong, the technology is leading, the demand is real, but risk management matters more than excitement, and protecting gains is just as important as chasing new ones. Diversification is powerful because it removes pressure from a single stock and spreads opportunity across multiple directions. By selling half, I am not stepping away from the AI revolution. I am simply positioning myself to benefit from it in a smarter and more balanced way. If you want steady growth and reduced risk, this is how I'm rebalancing. If this way of thinking helped you see investing from a new angle, make sure to like this video, share it with someone who needs to hear this, and subscribe to the channel for more clear and practical insights like this.